Welcome to another edition of the Nerdy Agent Podcast. I'm your host, Luke Pettersen, with my brothers and fellow nerds, Josh and AJ. And Haley does not have a mic today because we're in a different room, so that's a little bit weird.
She can hear us.
For everyone Haley's listening, but
everyone that doesn't watch us on YouTube, today is a great opportunity to see what it would be like and to figure out what you're missing because Luke is so tan right now.
Super tan.
Just got back from San Diego, overcast the entire time. You know the one thing...
It doesn't get overcast. It's San Diego's only sun.
The one thing our parents, Dad said, just make sure you watch a sunset. We couldn't see any of the sunsets, Dad, I'm sorry to say. We did buy a house on Friday, though. That was...
in San Diego?
No.
Oh, just kidding. We did buy a house.
Hive Lane bought a house. The brothers and our wives bought a house on Friday, and that's pretty fun.
That was really fun.
Super exciting stuff.
You know what I said was kind of laughable about that one was that I was more excited about the shed in the backyard for potentially storing all of the items that we need to store in St. Louis Park to fix things when they come up.
You know what's also super interesting about this house? It has 3 bedrooms on the listing, but if you go upstairs, it kind of only really has one because you can see through all the bedrooms into the other ones.
For those who don't know, we also buy. It's
an open concept bedroom.
It's an open concept bedroom floor.
We buy and flip essentially single families that we turn into rentals, and they tend to be in pretty bad disrepair.
We renovate. We don't flip.
Yeah, we renovate.
We would love to hear your thoughts on if we should include a dry bar with a teal fridge.
Yes.
So comment below if you have any opinions.
And
on
we're going to wrap it around to be the entertainment center for a mounted TV in the living room as well. I think that's actually
maybe I'll
the play.
Crank out my new table saw.
We should do a podcast from the properity.
Just sit on the floor?
Yeah, that'd be actually kind of fun.
Sweet.
All right, let's get into what we're going to talk about.
If you can't see us right now, we're sitting on the floor.
We got to get into the important stuff here because, like I had said earlier, our new camera only lasts 30 minutes and then it explodes, so we got to get rocking. Today we are going to talk about these hot button topic of loan level pricing adjustments, what they are and why you need to be able to talk about them with your clients, and in general, just you have the knowledge there. We're also going to have some,
hey, Luke, you hear about this thing? You know Saturday Night Live, have you seen the Bobby Moynihan where he goes, you hear about this thing though, guys? You hear they're making, right now they're making the loans more expensive if you have high credit scores? You hear about this thing? He's a secondhand news correspondent where he tells fake news essentially.
I love that.
He comes on the
Weekend Update.
The Weekend Update. That's
kind of what's going on right now.
That's kind of what's going on. But I do think that we'll have maybe some interesting opinions versus what the rest of the market maybe has opinions about this on. So stick around to the end. You can hear those as well. To start, we don't have a Would You Rather of the week, so we're going to get into it. What is a loan level price adjustment?
So people understand that like there's a lot of things that go into an interest rate when you buy a house, right? There's your profile as a buyer, which we'll talk about credit score specifically today. There's
down payment.
Yeah. There's DTI, debt to income, to qualify you. There's all sorts of things that can change
the type of loan you're getting, what type of property you're buying.
Well, and the rate and how much money it costs to accomplish that rate. So there's a rate and then there's a cost to accomplish that rate. So right now we talk a lot about paying points, right? And that's a cost that gets your rate into a certain position. And your profile plus the given marketplace is what's going to determine what happens with that rate when you pay that point. So a loan level price adjustment is what the cost is for different profiles of buyers that has to be spent in order to accomplish like a par rate or even to buy down a rate, right? So the news is that these are changing. So I don't know if you want to get into that a little bit.
Let's get the next
one.
Essentially,
high level, right? It's like there's like a base rate and then there's an adjusted amount of cost associated with different profiles. It's not like everyone doesn't get the same rate. So we say, rates are 6.5. That rate will vary, and everyone knows this. But like, if I have a 640 credit score versus an 800 credit score, or if I'm 80% down versus 5% down, you're getting a different rate.
Or if I'm bringing 20,000 to closing in points, or if I'm bringing 0.
Not everybody actually does know that. Like when the market says rates are 6.5, they're not 6.5 for everybody. They differ on your situation. There's also situations, for example, the 3% down home possible loan, where the lower down payment, as long as you qualify that for that loan from an income perspective, is going to be better.
Yep.
Because they have that specific program.
And I pitch it every week. If you don't have a very smart, good lender right now working with your buyers, you probably should find one.
Especially in this market.
Yeah, we've seen situations where my go-to guy says, let's put down 19.99% because it makes way more sense to be at 80.01 loan to value than it does to be at 80 loan to value, because the PMI is so low. And in certain opportunity zones, another thing that can change the cost of the loan, if you're under that 80% or over that 80% threshold, it changes the pricing completely. So we won't get that in the weeds on that, but we will talk about what's changed specifically with credit scores and costs of these loan level price adjustments.
Yeah, right into it. So what is this news that's come out about them?
So essentially, they've adjusted what the loan level price adjustments will look like. Starting May 1st, right? But the reality is those loan level price adjustments have already been in place now for a number of weeks, because it's about the May 1st is the delivery date. So lenders had already started putting this into play, because the reality is by the time that you get locked in, plus the reality that there's another about 3-week time frame that the delivery date is after your closing because of delivering to Fannie or Freddie. These have been in play for probably 2 months plus now at this point. But when people say on May 1st this is going to change, then on May 1st all the news articles are talking about all the major changes and how they're going to impact you. So it has been a much more hot button topic in the last week than maybe it should have been based on the reality of how these have played out. But essentially, the way they've changed them is they're trying to tighten the band. So historically, the band between low credit score or low down payment and higher credit score and higher down payment has been wider in these price adjustments, meaning you've had a worse rate by a wider amount if you're a lower credit score buyer than you are going to now moving forward. And the problem with the rate rises we've seen, plus the reality of just how affordable housing is right now, the goal that Fannie and Freddie is putting out here is to try to maintain affordability for lower credit score, lower income buyers, because the band had been so wide that it had just created a consistent problem of equality. So they're trying to tighten these up in an effort to make it fairer for people who have lower credit scores to be able to attain a mortgage.
And why does this, if I'm an agent out there right now, I'm listening to this podcast, this isn't very agent specific, right? I mean, you could just brush this off and say lender kind of handle this. Why should agents right now know what this is, know how to talk about it with their clients?
I think the biggest thing is, we get tons of Zillow first-time homebuyers in the door, right? And I read conversations where credit score becomes a problem, right? And that might be because their credit score is 550. That's not what I'm talking about here. It's more so the 620 to 700 borrower is seeing their affordability go up quite a bit. If they needed to bring, let's just use $4,000 to closing to achieve the same rate as someone at a 780 before, it might be $1,000 or $1,500 now. So loans have become more affordable for those kinds of people. And thus, if they, like my situation I just presented, if they want to pay points, great. It's more affordable than it once was. But if they don't want to pay points, their actual par rate is going to improve because of these changes. Yeah,
and I think, not to jump ahead to a script, but if you have a buyer that's like, my credit score is just not great, maybe I'm going to rent for another year, it gives you an opportunity to say, hey, they just recently adjusted these loan level price adjustments to make lower credit score borrowing more affordable. So it would be worthwhile for us to at least talk to a lender and see what you can afford and what you can get into, because you might be surprised at what rates you can get access to nowadays based off this change. So that can help you continue to funnel maybe a lower credit score borrower through the process, but also, once again, continue to make you sound smarter when you're talking to potential clients. On the flip side, there's a lot of clickbait news coming out in the last week that's saying, oh yeah, it's actually more expensive to borrow if you have a higher credit score. This is unfair.
I want to make sure before we
be able to answer that question too.
Yeah, I want to make sure before we get into more biased opinion responses that we make sure we point that out. Like, it becomes our opinion at some point to an extent there.
Well, that's just, I'm saying, speaking more so to being able to understand what's going on here, because you may read that same article and you may say, yeah, you're right, it is more expensive now to buy if you have a higher credit score. When the reality is that may not be the case. Understand how this actually works.
If you are 80% loan to value or lower and you have over a 780 credit score, you saw your loan level price adjustments improve. For the record, those were changes from the previous numbers they had. It got better. So it didn't get worse for those people. It actually just improved, just like it did for a lot of other scenarios here.
Yeah, and your rate still may be higher than it was in some scenarios versus where it would have been before this, but your rate is still going to be better than someone with a lower credit score. So there were like articles saying, hey, you should intentionally lower your credit score so you can get a better mortgage rate. That's factually incorrect. So
correct.
The reality is yes, your loan level price adjustment may be higher now than someone with a lower credit score, but your starting point is better. So you're still ending up with a better mortgage rate than someone with a lower credit score.
Your change from the previous loan level price adjustment.
Yes. The arbitrage you could run into is some sort of recasting system, because my understanding is when you do get, let's say you're above 780 on the graph I'm looking at, and you do put 20% down, there is a situation where you might have been better off putting 5% down.
There are opportunities that exist because of these changes that are important to at least evaluate.
You don't
with
agree
your
with
lenders.
that?
On the graph. at 5% down.
You may be better off putting
yes.
5% down instead of 20 if you have that cash, and then recasting after the fact. You
Yes,
may
which
find
a
that's better.
lot of, I have clients doing similar scenarios right now.
Yep. So that's another call out to what AJ's point is. I mean, we're getting a little bit off the loan level price adjustment stuff in terms of how this actually is working. But having a smart lender is important because you may have opportunities to do it a little differently than you were planning and actually still end up in the same outcome place when it comes to your monthly payment, but save some money in the process.
The largest changes, so that you guys know, we can post this graph somewhere on here, I think. Yeah. The largest positive changes we're seeing in the 5% down buckets. So across the boards, the 5% down buckets improved the most. If you look at anywhere from 620 all the way up to 850, whatever the scores go up to now, the biggest decrease, like the biggest increase in cost for borrowers on loan level price adjustments were those that were putting down between 15 and 20% and have between a 720 and a 760 credit score.
Yep.
But also those people, just to reiterate, were also the ones that were getting the best rate out of anybody getting a loan. So their rate is still going to be better. Correct. It's just going to have gotten worse, more worse than the other ones.
The most important thing to realize in this conversation is think about this as a change versus an actual, right? So you're seeing these things being reported, but the reality of what's being reported is it's a change that's being reported, not the actual new rate is going to be this much worse than this other rate.
It's kind of like when these big news outlets come on and they say foreclosures have increased by 600%, and you're like, yeah, they went from 2 to 12.
Yep.
That is 600%, but it's only 10 more foreclosures. So this is the clickbait type articles that you're talking about. But to your point, it's still going to be better for you to have a better credit score. And I think the biggest thing to talk about here is people always want to, when they hear these kinds of news, they always want to go on and spout out about how it's unfair because they're comparing themselves to others. All that really matters is when you're talking to your buyers is what is their situation doing.
Yep.
So you just say, it doesn't matter if someone with a 625 credit score just got a better deal at 5% down. How does that impact you at all? It doesn't, right? You're at a 755. Let's just look at what happened to yours and just reprice what you're doing, because that's what's changing. And to Josh's point, it's probably already been factored into the pre-approval that you've done before.
Yes. And there's, the construct of fairness is a very unique construct. So, we talk to my kids all the time about what's fair and what's not fair, right? But anytime anything negatively affects a person, they tend to think it's unfair. Anytime it positively affects a person, they tend to think that's the way it should be. So just the reality of the way the world
That's
works.
the one thing that I do think that agents obviously agents always trying to, in general on social media, people tend to try and have a controversial take because it gets them more views, right? I do think agents should be careful when talking about this being a bad thing, because one could argue very quickly that the history of credit scores and how they gave people mortgages was created in a very bad and unfair way. And the whole goal of this is to lower that gap and make it a little bit more fair for the group of people that are trying to buy houses.
You're in theory trying to correct years of unfairness
exactly.
with a new model that may seem unfair to what you were getting before, but the reality is things have been unfair for a long time for other people.
Exactly.
I think too, and people probably been spouting off about this as well. I don't think these changes are likely to create any massive movement within our marketplace, but they're good to know about so you can better advise people. Like we said, 3 or 5% down conventional loans just got a heck of a lot more affordable for every single credit score.
Yep.
So that's one thing to probably talk with people about. And again, if they haven't been pre-approved yet, so people going forward, you can mention that to them. Like people with under 639 credit score just improved by 1.75% under 95 or greater
right.
LTV.
In a market like the Twin Cities, where we've been dealing with what we call an inventory crisis, How do we think that this is going to affect that?
It's a great question. I think you're looking at the borrowers that are probably in that 10 to 15% down bucket that have stable jobs and good credit scores are going to see increases in the amount of money that they have to spend to get the loan that they got before. So it could decrease demand slightly in that regard. It is, we've talked a lot about demand versus affordability, and we haven't, at some point the rubber's going to meet the road, I think, but right now we still haven't seen a massive decline in demand because of affordability. It just, the lack of housing has completely outpaced any movement on the demand side of things.
Yeah, and I think the problem we still have is, even though this is good in a way, because the folks that are struggling right now are the ones with lower down payments, lower credit scores, because they're competing in multiples and they're just getting destroyed. So this, in theory, opens up their ability to potentially push their budget up a little bit, because if their rate comes down to where they're expecting it to, they could, in theory, get pre-approved for a higher dollar amount when it comes to their monthly payment getting stretched further. So that's potentially a good thing, right? Because it could open up their search a little bit to give them more access when it comes to the availability of inventory. But cash is going to continue to be king because, the prices are going so fast again that appraisal gap coverage, having higher down payments, being a 3.5% FHA down buyer just doesn't look that competitive when you have 15 offers, right? It still doesn't look competitive. So you still do struggle a little bit when you're in a position where you have a lower credit score or less cash sitting on hand.
And to be completely clear on this point, so we can give you a very real example, in this article that we're kind of working off of, using 80% loan to value as an example, your loan level price adjustment at a 640 credit score is 2.25% versus 0.875% for a 740 score. Difference of 1.375%. That's just over $4,000 on a $300,000 mortgage. So if you have a 740 versus a 640 in that scenario, you're still $4,000 better off in your pocket than having a 640 credit score.
Yep.
It's just that it's half the previous difference.
Yep.
So it's worse than it was when you're comparing to somebody else, but you still are $4,000 cheaper to do the same loan.
Tightening the bands.
Exactly.
So to finish up, I want to get into the script of the week. So script of the week, and you already kind of mentioned one really good one about somebody who has a lower credit score, didn't think that they would qualify. It's a way to say, hey, your rate is better than it was going to be. Maybe this is something we can talk to the lender about. The other one I want to talk about is the friends, because I do think that I know for a fact that when stuff hits the national headlines, your friends start to see it. And I had in a group chat, actually a couple weeks ago, I had a friend send the article that said it was something along the lines of Biden to make housing more unaffordable for people with higher credit scores. It was somewhere along those lines. And he said, what is this, Luke? And I'm curious, what would your response be to this?
Technically, depending on your credit score, that happened, right? That being said, you're still much better off with a higher credit score than you are with a lower credit score, no matter what. I can show you the graph on that. And that being said, if you have over a 780 credit score and you're putting down at least 20%, you actually saw an improvement in your rate. And to our point earlier, if you have over a 780 credit score and you're 5% down, you saw a 0.625% improvement in your rate. So it's not just the low credit scores that are getting improvements. The high ones are actually getting improvements as well, especially at lower down payments. The people between 720 and 760 are the ones that are probably getting hit the hardest by this, depending on their down payment. If you're in that category, I would encourage you sit down with a lender who understands credit scores and try and improve that thing so that you actually sit in that higher bucket later on.
Yeah, I would say the headline there is trying to read about the unfairness part about it versus the fairness part about it, right? So the reality is that we've been looking at a pretty wide band between high credit scores and low credit scores, and there's plenty of history within the reality of credit scores to suggest maybe we're overstating the importance of them in this process. And so when they looked at it, they said, well, housing right now is very unaffordable, and it's very tough to get access to because we have an inventory shortage. And so for people that are lagging behind when it comes to credit scores, finding a way to get them into a house at some point in their life is becoming harder and harder right now. So the adjustments were made not to disadvantage one group, but to try to make it a more level playing field in terms of the gaps between the high credit scores and the low credit scores, or the haves and have-nots. So it's it's an attempt to try to even the playing field a little bit, not disadvantage it or make housing more unaffordable for high credit scores. Your housing is still more affordable if you have a high credit score than a low credit score, to AJ's point. But the playing field is a little bit more level than it's been in the past.
Here we go. Here's the statement by the director of the Federal Housing Finance
Let's
Agency.
finish with that. I just want to touch on this.
I want to give some homework at the end of this too.
Also, you can in this in something like this happens, you can utilize this to your advantage with your friends as well, right? You say this and you say your credit score, based on your credit score, if it is really high, based on your down payment, your rate maybe has gotten worse. The good news for you, Josh, is that I work with a really good lender who knows how to get around this stuff and how to play with your debt to income, with your credit score, with your down payment, how to adjust those things to make it so you still, to optimize those things so you still come out in a really good situation. And so when you get to that point, just reach out to me. I can connect you.
Yeah, it's phenomenal.
That's better than my script.
That's great. And
I like that, though. They should know that. That's important to me that people know.
Well, and I think, too, the people need to understand what Fannie and Freddie's actual mission is. They're now a government arm. They have been since, I think, 2009. The director, Sandra L. Thompson, quoted when they announced this back in January. I mean, it was going into effect, I think, even in October. By locking in upfront fee eliminations announced last October, FHFA is taking another step to ensure that the enterprises advance their mission of facilitating equitable and sustainable access to home ownership. Our country has been built on helping people get into homes. This is just following that framework and that plan.
Can I give a quick homework assignment?
Yeah, and then
so for every agent out here that listens to this, right, this is a pretty confusing topic, right? This is even confusing for us in some ways, right? These loan level price adjustments, they're complicated. So you should be leaning on your lenders very heavily to understand what's going on in the financing world, but you should be learning, and that's why you're listening to this, so that you be better in communicating with your clients, right? That's your goal. My homework to you this week would be, you listen to this, you got our take on loan level price adjustments. If you have a preferred lender, reach out to that lender, give them a call and say, hey, tell me more about this loan level price adjustment stuff going on right now. I'd like to make sure I understand it so I can communicate it to my clients. Part of that is so you can continue to learn, but part of that is also to kind of quiz you to make sure you got a good lender. Because if they start telling you things that are very different than what we're telling you, then you got to do your homework and make sure you know which one of us is actually telling you the reality of what's going on. And if you feel like your lender is not understanding something like this, then they're not taking care of your clients the way that they need to be taking care of your clients. So I'd highly encourage you to continue to learn about this and also to ensure that you have, to AJ's point, a really solid lender who can take care of your clients.
And don't be afraid to ask what you think is a dumb question. The second you ask that, he's probably going to say something or she's probably going to say something that you go, I don't know what that is, but I'm already asking about loan level price adjustments. I don't know these. Just stop the lender and ask them that as another question to learn more about it, because you can't learn things without asking questions. I feel like a lot of times I'll explain something to somebody, like a client even, and they'll look at me and I'll be like, I know you didn't fully understand. Or one of my high school baseball players, like, I know you didn't fully understand what I just said. Like, just ask another question about it. Like, it's not, you can't have bad questions because you can't ever learn anything without asking them.
Yep. A lot of this we learned from our lenders, just to be clear.
And I ask him so many dumb questions.
A lot of this. So,
and to clarify with a closing remark, people are talking about 40-year FHA mortgages. This is not a thing. So don't tell your clients they can do a 40-year FHA mortgage. This is only for loan modifications of people who cannot pay their existing FHA loans. So another thing going on in the loan world right now where you're seeing articles being sent all over the place that's just completely
incorrect. Which is actually kind of cool. They're trying to stop them from going into foreclosure.
Exactly.
That's nice.
Well, and even like think about the FHA MIP changes that happen now. The FHA loans are more affordable. So once again, having a good lender, because that lender may say, actually, you should be FHA versus conventional.
There's going to be more people
money
doing
on
that.
this, right? Mm-hmm. There's all of these things going on with these changes that, to Luke's point, you can call it arbitrage. You can just call it a change in how do you optimize your situation. But there's significant money on the table if you have a good lender. So have those conversations, make sure you're in the right hands, and make sure you're always focusing on learning.
And that's all we have this week for the Nerdy Agent Podcast. And as always, remember, be better.